All right, so this webinar is now being recorded. And again, I want to welcome you all to Alternative Financing, Where to Go When the Bank Says No. I hope you're here with a desire to learn more about how to get some financing for your small business startup or expansion when sometimes the banks aren't able to do that for you. We'll go over quite a few things, but first, before we get started into the actual subject matter of the presentation. Shannon, everybody, you can all hear me okay? Want to make sure. Okay, just to make sure the volume's good. Okay, my name is Rich Foster. I'm the director of Valley Community Small Business Development Center. And the reason I'm doing this workshop is because I'm what's called a recovering lender. I used to be a small business lender for a community development financial institution for many, many years. And my job was doing lending from the cradle to the grave, sourcing the deal, packaging the deal, presenting the deal, and then servicing the deal. And so I have a pretty strong background on this. And as an SBDC director, all of us here at the SBDC, including our wonderful team of consultants, are charged with trying to help you find the best possibility, if they exist, for you to get the financing for your business. Just a bit of Zoom etiquette to go on to this is that you make sure you follow, if I get on too many blocks here, make sure you put all your questions in the Q&A feature at the bottom of your screen, and we'll do our best to answer them all at the end of the workshop. So with that, we'll move on to the next one. Okay, or maybe we won't. Let's see. Shannon, I'm having a hard time getting this to work. Bear with me, everybody. Let's see how we can get this going here. Page down. Oh, there we go. It's just slow. Okay, well, that was an easy fix. Again, thank you very much to our sponsors. Our Small Business Development Center here serving Fresno, Madera, Tulare, and Kings counties is basically funded by the U.S. Small Business Administration. They provide all of our core funding so we can provide services to you. And we get some supplemental funding from the California Governor's Office of Business and Economic Development, otherwise known as GoBiz, to help us actually provide the one-on-one counseling that we hopefully feel that most, if not all of you in this audience, have taken full advantage of. That's what we like to hear. Basically, we are part of the Central California SBDC network. Our network covers 15 counties from Bakersfield to Modesto, from Fresno to the Central Coast. We're part of 6 centers, and as I said, our center serves Fresno, Madera, Tulare, and Kings counties. If you're outside of the area, feel free to contact us if you'd like to know how to get a hold of an SBDC in your area. And again, what we do, just so you know, many of you on this workshop are already seasoned SBDC clients, but we provide confidential, no cost, no obligation, business consulting and technical assistance to help you start, grow, expand, or strengthen your business. And we have just the greatest team of consultants on the planet. And if you do need some help, go to our website, valleycommunitysbdc.com. And in fact, I think we have a visual of what it looks like. It looks like this. Go to our website and hit the Get Started button. It's going to ask you a couple of questions, and then you move forward, and that gets you into our system, and we get you some counseling after we make sure you know what you want to get accomplished. We check that with you, and then we get some people to sit down with you one-on-one and help you make your dreams come true. So again, please take advantage of these wonderful services. They are no cost, but we all pay for them. They're paid for by your tax dollars. So make sure you take full advantage of that. Oh, I love the big disclaimer we need to say. The information discussed today is based on our current understanding of materials covered. Things change. If any of you have lived through the last 2.5 years, things change all the time. But we encourage you to consult with a business professional, whether it's a banker, accountant, or attorney, or your SBDC consultant to further understand the topics that are covered today. So with that, I'm going to go over what we're going to cover today. Hope you're all getting a good concept of what we're trying to accomplish here. We want you to understand the lending landscape. What is it out there right now? What does it look like? What are the opportunities? What are the realities of that? and we'll go over that. Know what you need and how much it's going to generate revenue for your business. That's a critical thing. You got to be able to say, I want so much, it'll allow me to do something, and then how is that going to impact positively my business? Understanding the type of financing you need, whether it's a term loan or a line of credit or a regular loan, or you'll probably hear the term guaranteed loans quite a bit. And I want you to know the difference of those. We're going to talk about what all lenders look for so that you could be prepared. If you have any strengths or weaknesses, you can highlight the strengths and work on the weaknesses. But they're called the C's of lending. And we'll go over all those wonderful C's together. We're going to talk about the hierarchy of lending, which is, what's in order of preference for you as a borrower. What are your choices? And then we're going to talk about local resources and how you can find out more about the different local resources and regional resources that can help you, hopefully, on your quest for funding. So far, we're doing okay, I hope. Shannon, are we doing any, do we have any questions in the chat anywhere or in the Q&A box?
Not yet.
Okay, then they must be glued to their screens. Okay, first thing I want to talk to you about is understanding the lending landscape. This is a very serious issue that here at the SBDC and throughout the country we have to face, is coming out of the stimulus era. During the height of the pandemic, there were programs being created very quickly, being launched and deployed, and every time you turn around, there was a new one and a different one and all kinds of things happening. We got exposed to a number of different loans that were never used before, like the economic injury disaster loan for specifically a pandemic. That was never done before. The payroll protection plan loan program was never done before. And then there was all kinds of other sub loans and things. But small businesses, for the first time in my history of 40 plus years of doing this, were given the opportunity to apply for grants much more than they ever were in the history of our economy, because normally grants are for nonprofit organizations, not for-profit mom and pop businesses. And grants came out. We had the Shuttered Venue Operators Grant, the Restaurant Revitalization Loan Program, the California COVID Relief Grant, and all kinds of other sub grants and things that just kept coming up over the period of 2020 through even recently. We still have a few left. But what I want to make sure you understand is that whether good, bad, or indifferent, we're not going to see a continuation of new programs. We may see a few things for another year or so, but it's very much going by the wayside. I believe there's the intent of everybody getting back to as close to normal as possible and normal standards. So right now, I want to make sure you know that there are some grants out there, like, for example, most counties have a COVID relief micro grant for very small businesses of less than 5 employees and making less than $50,000, and it's a $2,500 grant. There are grants in the city of Firebaugh to help with business expansion. There are small business grants by different private players like Google and FedEx and things, but they are very much going to dwindle down over the next 6 months to a year. So you might want to think about, if your only focus is going for grants and that's all you've thought about and you're not going to even try for a loan, know that that's a short window and it is closing rapidly. So be aware that there may be talk of grants, but there are not too many out there. Loan availability, like I said, there's not going to be a lot of incredibly low interest, easy to get if you can justify a harm, due to the pandemic or anything, type of loans. There does not appear to be on the horizon any forgivable loans, which ultimately are a grant when you look at it. So what we have to start looking at is the reality of what the lending landscape is going to look like. It's going to look like what it did in 2019 and earlier, and that's traditional lending, where you're going to be looked at as a small business and you're going to be rated based on risk factors that we're going to talk about. One of the things I've said in the many years I've been doing workshops on small business lending is please, please, please understand there is no such thing as a fast loan. A lot of folks go to lenders and they go, yeah, I need my money next week. Well, that's just not going to happen. And the most common question I ever got as a lender is, how soon can I get my money? Well, number one, that's a little scary to the lender because they're thinking, what's the problem? Why do you need it so quickly? And number two, the standard answer is just as soon as you can get me all of the materials I need, and there are no hidden surprises. There's no findings. There's no hidden tax liens or bankruptcy in the past or anything like that, or credit issues. So again, fast loans, don't think you're going to have a turnaround time. That's going to be anything shorter than a month or so in the best case scenario. One of the issues that, seemed to fall a bit behind was there's, owner injection has always been a standard for lending. And, a little bit of that went away when it came to especially specialty stimulus loan programs. But the traditional owner injection, or skin in the game, as it's known to be called, is 20%, especially for startups. But 20 to 25% seems to be the trend we're seeing. And it's where, again, there's no such thing as 100% loan. So for example, if you need $100,000 to expand your business, any lender is going to say, okay, well, where's your 20,000 to put into it, and we'll loan you 80. We'll look at that scenario. If you're a startup, more than likely they're going to lean towards the 25%. And the simple logic is it's more risk to the lender, and they want to mitigate that risk as much as possible. And I will tell you, as someone who has owned many small businesses and has helped people with small businesses, when you're an entrepreneur, for those of you who listen to this recording, there are times where you sit at a table and you're just there at 2 o'clock in the morning saying, why did I do this? Oh my gosh, this is really hard. And then you realize that if you didn't have your investment into it, it would be easy to walk away. And that's what lenders are thinking. So no, you've got to get an owner injection. We're often asked, well, I don't have the cash to do that. What are my options? Well, there aren't too many options, but some smaller CDFIs and other lenders will consider if you invested anything previous to the loan request into your business, and within a recent time, within a year usually. So for example, if you bought a truck to haul your hay, or you bought a specialty printer to do your graphic designs or anything like that, and you paid for it out of your own money, sometimes that can be counted towards the owner injection. So it's not always cash, but it's usually, if you don't have it, the cash is necessary. If you don't have that injection of something that you put into the business. For nursing homes, if you paid the money to get all your licenses and everything up front, that could be counted. So just know 100% financing, not really a thing you're going to see too much moving forward. And I mentioned this a lot, and you'll get this in a slide coming up, but the C's of lending are back in play. And it's just a trick of the words that lenders use, but it's different words beginning with C that all lenders look at. And, again, we'll go over each one, but I've seen anywhere from 3 to 28 C's, and we're going to focus on the top 5 today. And then the funding decision is going to be made by the lender. It's not going to be an automatic approval or decline based on if you meet certain criteria. What lenders are going to be taking into consideration is their portfolio, the amount of risk involved in the deal, the amount of saturation they have. Maybe they have too many businesses similar to yours. So you may even have a good deal where a lender say, well, we have too many of your type of business right now, and we're worried that if something goes wrong with that industry, it could hurt us and keep us from making more loans. So ultimately, the change, I just want you to be aware of, and I'm not trying to be gloom and doom, everybody. I just want you to be aware, because the more prepared you are, the better you're going to be and the stronger borrower you're going to be. But the lender ultimately has the funding decision. And it's not like a government-backed issue where if you just meet the criteria, you're going to get it. The funding decision is made by the lender. Okay. How are we doing, Shannon? Any questions? Shannon's probably taking.
I'm sorry, not yet.
And if there are, just raise your hand and I'll notice you. Then I won't call you out every time. She's probably doing 15 things at the same time, folks. So just so you know, understanding loan structures. Again, it's really important when you talk to a lender that you know what you need. And I want you to know 4 basic terms that will help you become more knowledgeable and more attractive to the lender. One is a term loan. A term loan is very simply this. It's a loan that has a start and an end and set payments. For example, if any of you have bought a house or a car or furniture, whatever, and you say, okay, it costs me this much money, I'm making monthly payments for so many years, and at the end of that period, it is mine and I don't make any more payments, that is a term loan. That is the most common thing in financing, is a term loan. Where the confusion comes to mind sometimes is with a line of credit. A line of credit is a specialty loan that is targeting businesses that have accounts receivable. And what that means is very simply, it's very common with companies that have to do work and then wait to get paid. For example, typically in the construction field, go out and do all this building work and get it done, and then you'll get either progress payments or payments down the road when the job is done. Trucking companies, hey, you got to make 4 hauls before we can pay you on this. Okay, well, it means I still have to pay for my employees and my gas and all these things. So you need money to float that project, to float that job until the person you're doing it for can pay you. That's the kind of business that can use a line of credit. You can't be a retail store. You can't be a manufacturer who's going to turn around and sell products every day right out the door. You can't be those kind of things and get a line of credit. A line of credit is specifically for those accounts related businesses. If you're a consulting firm and you sell only to school districts and it takes a long time for them to pay you, yes, that could qualify because you're waiting to get paid and you still have to do the work. The structure of a line of credit is fairly simple. Term loans, average business loan, terms between 3 and 5 years, sometimes up to 7 or 10, depending on what you're purchasing with your term loan. A line of credit is usually 1 or 2 years, most commonly 1 year, where the way it works is if you borrow $100,000 on a line of credit, whenever you need money, you draw down from that line of credit and you pay only on what you draw down. You pay interest only on what you draw down. And then at the end of the year, the lender is hoping that, with the money you got in from your contracts that you collected, you pay that down to 0. So here's the scenario. You get a line of credit and you're selling to the government. And okay, you needed $30,000 of your $100,000 line to get that project going. And you do it and the government pays you and they pay you $50,000. Well, you pay $30,000 down to the line and get down to 0 and you keep the 20 as your profit. All lines of credit have an end date that's short, usually a year. Sometimes there's 2-year renewals, but every year you've got to get a new line of credit in the traditional sense. And most lines of credit, unless otherwise deemed by the lender, which is very rare, will have a 0 rest period, which means at least 30 days during the year, you've got that down to a 0 balance. The big issue with lines of credit, even for those who qualify for them, it's easy to be a human being. It's easy to turn around and say, oh, I just need this money, and you're not going to be monitored as strictly in this. Okay, I'll take it, I'll pay it back, and you don't. And then the money may not come in. And so you end up with a balance at the end of the year. That is not good. Lenders do not like that. And they'll do what's called a term out, and they'll convert your line of credit into a term loan and probably not be too much more inclined to loan you any more money. But just please know that if you're looking for a term loan or a line of credit, just know the difference. And you may talk to your lender and say, what's best for me? But knowing how they work is important. And these are two other phrases I just really want to get some clarity on because there seems to be a lot of confusion out there, especially lately. There are direct loans and there are guaranteed loans. So on a direct loan, that's a loan from you to you from the lender, period. No questions asked. The lender loans you the money, you pay back the lender. The confusion sometimes happens is, again, there are federal loan guarantees and there are state loan guarantees. The Federal Loan Guarantee Agency is the U.S. Small Business Administration, and the State Loan Guarantee Agency is the iBank, but it's also administered here locally through a CDFI. And what a guarantee is that if you wanted a direct loan from a bank or a CDFI, and you had a little issue, you have something that makes it not as desirable for the lender to make that loan happen, they can ask to put a guarantee on that loan. And they would have to solicit either the SBA on the federal side, or they could choose the state on the local Valley Small Business Development Corporation side. The difference is this to you. A guarantee is not the loan itself. It's not made by the lender. You can't go into a lender and say, hey, I want a guaranteed loan. They make that decision. And what it is meant to do is give the lender the incentive to actually loan you money. So maybe you've got a great situation, but there's a collateral shortage. That's the most common reason for a guarantee. You don't have enough collateral. If they get a guarantee from the SBA or from the state of California, that will guarantee a portion anywhere between 75 and 90%, depending on the guarantee type, of the loan up through the life of the loan, or 7 years usually. So that is something that's great if it's needed, but it's the lender's choice. Very important that you know that you can't say, I want a guarantee. And I'll tell you, if you don't need a guarantee, don't ever ask for one. Having run a guarantee loan program in my past, here's the issue. It's great if it'll make the deal happen, but even so, what that means is double the fees. You're going to pay loan fees to your lender to make that loan happen, but you're also going to pay guarantee fees. It's also going to add a little more time on the paperwork end. So guarantees, when you hear talk of, hey, I want a guaranteed loan because I hear that's the best deal in town, only if it's necessary and only if you have no other choice. Okay? All right. Well, hopefully we're not overwhelming you with details right now. It's very important that you prepare, whether you do a full-blown business plan or you at least have a one-on-one meeting with a potential lender. You want to know a couple of things, and you want to know it well. I'm talking rehearsal, folks, so please keep that in mind. First, how much do you want? The worst answer you could ever get when you're talking to a lender, when they say, how much do you want? And you say, well, how much can you give me? Don't ever do that. You want to know how much you want and then what you're going to do with it. How is that money going to make you money? So, for example, if you go into a lender and they say, well, how much money are you looking for? You're saying, well, I have a need to buy a piece of equipment that will allow me to improve production by 10%, and it costs $50,000. Okay, well, the next question is going to be, well, how much will you contribute to the project? Well, I have 10,000, so really I need 40,000 to buy the equipment. And maybe you can negotiate other things, like you'd like a little working capital or something. But again, demonstrate that you're willing to contribute something to the project so that there's skin in the game, as I mentioned earlier. And how will the funding impact your cash flow? What is it gonna do? Is it gonna increase your sales? Is it gonna allow you to better do what you do to cut costs? Is it gonna do something that's gonna improve revenue and cash flow? That's really important, because what all lenders look at is your ability to repay the loan. And if you can't demonstrate that, it's hard for them to make a yes decision. And then be able to do, and I say paint the picture, but there's a lot of expressions out there, elevator pitches, and 2-minute overviews and things of that sort. But the bottom line is, explain in layman's terms what you do, why you're good at what you do, and how this loan is going to make you even better. Focus on those things. Focus, because it allows the lender to both understand and believe and get buy-in. And when your lender believes in you, they will go above and beyond to try to get you your loan. Let me tell you too, another fact, next lender fact here. There is no such thing as a lender that does not want to make loans. All lenders are basically paid in some way, whether directly, indirectly, or through some sort of commensurate schedule, are paid by the number of loans they do. So there's never a time when they, oh, I have too much work, I don't want to make loans. What they want to make are good loans. What they want to make are loans to people that they feel very comfortable won't default and they know what they're doing. So that's what I'm kind of priming you for, is to give them the recipe and the food they like, and your chances are a little bit better. Okay, we're going to talk about the wonderful C's of credit or lending. I shouldn't say C's of credit, that's a bit redundant, right? But this is something all lenders look for. And it's funny because in my history, I've seen this go from 3 really important ones to up to 28. And I guess if you want to have a party game some night, you can say, well, let's make up a new C for lending, capitalization or connectivity or something like that. Just don't say COVID or anything like that. That won't be a positive thing. So lenders look at these things, and it's not necessarily in this order, but I'll tell you the first thing they will look at by far is your credit. Personal credit comes into play when you are a business owner. Please, please, please do not fall into the trap of thinking that, hey, I started an LLC or a corporation, and that in essence is a separate legal entity, so my personal credit doesn't have to be looked at, because yeah, I've got some issues with my credit, like most people do. Bottom line is this, is that anybody who has a 20% or greater ownership of the business that's looking for financing has got to do a personal guarantee, which involves providing your own personal credit report in order to support that loan. So credit is an issue. We've gone through a lot of swings with credit in the last 2 years. Back in the Stone Age, boy, 720 was what you needed. That was the big number for many years. And it went all the way down into the low 6s, and it's hovering now on average around 650. Most people want to see. It just depends on the lender. So if you've got a credit score, my recommendation, and it's just a suggestion, if you got a credit score of less than 600, you might want to talk to a credit counselor or a credit recovery center or something like that and say, how can I repair my credit? Because it's going to be hard for a lender to justify that, because credit ties directly into your character. Character is split off into 2 things. How you've paid your bills in the past, which is reflected in your credit report. If you show a lot of derogatory credit issues and bills that weren't paid, and there's no logical explanation for them, they say, well, your character's a little shaky there. But also your character is, how well and how fully trained are you to run this business? How do you do this? What makes you the right person to do this kind of job? And so between those 2 things, it's very important that you focus on yourself a little bit and make sure to say, I've got experience, I've got this. And getting it back a little bit on the credit side, if you do have credit issues and they are explainable, and that's a magic word, explainable. If they are explainable, make sure you have that explanation handy. For example, and this is going to be a very common thing for the next couple of years. I lost money, I lost my job, I lost my house, or whatever it is, due to whatever situation, pandemic, economic downturn, whatever it may be. Or I had a medical issue, or unfortunately I got divorced, or something happened where it took a real hit on your credit and you had some problems with that. If it's a one-time thing and it's looked at on your credit report as a one-time thing, it happened during this period of time, and since that your credit has been clean, sometimes with the smaller nonprofit lenders like CDFIs, they could take that into consideration and say that was a one-time thing, and hopefully it won't happen again. Therefore, we can move forward a little bit on that. So keep that in mind. What you can't do, and I've had them, my friends, I've had them many times over the years of, I got all these credit card offers and they just look so good, and Tahiti was really looking good to me, and I just went on vacations and did all kinds of fun things and had a great time, and I just didn't want to pay it back. That's not going to be a good thing with a lender. So keep that in mind. Capacity. Do you have the ability and the wherewithal within your business to get the job done? Do you have the ability to make it happen? If you're buying a large piece of equipment to do more graphic design work, but you're the only employee and you're saying you're going to increase your clients by 200% and you're not hiring somebody, does that put an idea in your head? Maybe you don't have the capacity for this and you need to rethink it and say, well, how much is it going to cost me overall with new employees and new costs for shipping and new costs for packaging or whatever it is. Capacity is your overall ability to do the job. You know, I've had plenty of times where unfortunately it's a really tough business is trucking, where there's always rules in California that make your truck obsolete, you know, right away, even though it's probably still good for many years, where I've had truckers come in and say, I want to keep doing this, I want to expand it, I want to buy another truck, but their existing truck is not in compliance. And you can't make money theoretically if your truck is not in compliance. And I won't go down that path with you, but it's a common thing, and it sours the deal if you don't have the capacity. Capital, again, this is something I've repeated the repeat of the repeat, but capital is basically how much money do you have to invest in the project? If you're buying a building, if you're buying inventory, if you're buying anything, and there's a cost to it, you should think about that 20%. And do you have the ability to put that in there? Collateral, for those of you who don't know the word collateral, collateral is very simply, what can the lender take from you? What tangible things, things they can touch, can they take from you that will allow them to recoup their losses if they sell it? Now, what's the most common form of collateral? Obviously, it's business assets. Depending on the type of business, that's not always easy. Unless you're a retailer or a manufacturer or, you know, production type business where you have a lot of equipment and materials and things like that, or inventory, not a lot of physical collateral. If you're a home-based consulting firm, you have your brain and a computer and a cell phone, and that's about it. So again, collateral, the next thing that most lenders will look at is your personal property. If you own anything personally, like a house with some equity, or you know, rental property or land somewhere, that's the most desirable. But you've got to turn around and have collateral that usually is at least equal to the amount of the money that you're looking for. We're seeing a little bit of, how do I say it, lessening of this requirement right now. We're seeing lenders who are being a little more relaxed with their collateral requirements. And I say to you all listening to this, enjoy it for as long as you possibly can. But collateral is something that is very important to most small business lenders, the smaller CDFIs that we'll talk about in a moment, especially because they have to collect that money. And if they don't, they can't make more loans because that replenishes their loan funds. As I stated earlier, sometimes there are some mitigating factors in terms of collateral, one of them being having your lender obtain a guarantee from the SBA or from the state of California. Or sometimes you can get a guarantor on a loan. So you have a very rich and gullible relative or a partner who has assets that are much greater than yours. If they're willing to pledge, and as a partner, if they have 20% ownership, they're going to have to anyway. But say you have a rich uncle who says, I believe in you. Sometimes, depending on the lender, they can turn around and pledge as a personal guarantor on the note that if you don't pay the loan back, they will, and they have the assets and the collateral to back that up. So that is a possibility. Conditions, and that is looking at where we are right now. You know, a year ago, if somebody came to you and you were a lender and somebody said, I want to start an outdoor venue with an indoor restaurant, what would you say? Well, this is kind of a rough time to do that. There are a lot of rules that are keeping most traditional businesses from doing that. So that may not make much sense. I had a client a couple years ago come to me and say, I want to start an airline. I said, oh, a little private jet service. Oh no, an airline. And just the regulations and the fees and then that's when gas prices were going up and the various airlines. He mentioned the model of the airplane he was going to purchase, or the airplanes, and they were all the ones that were crashing at the time. I won't go into the details, but it was a very well-known thing. So not good conditions. Sometimes, right now, if you started a courier service, one of the conditions that would really be looked at carefully right now is gas prices. They seem, knock wood, they seem to be stabling out a little bit and hopefully dropping soon. But again, they went up an exorbitantly large amount in the last 6 months. So conditions are what we're looking at. Another big one here in the Central Valley, for those of you who are joining us locally, is drought conditions. If you're growing something, or you have to do irrigation, or you're a water truck company, water is hard to get, and it's getting more costly to drill, and wells are getting more expensive. There's waiting lists. There's all kinds of things that are local conditions that may apply to whether or not you can get your loan. But overall, a lender will look at these Cs and say, okay, how can we address all these? And if there are any shortfalls or issues or problems, what can we do to mitigate those? And I see we have something in the chat. Yes, this presentation will be available to rewatch. We are going to record it and put it on our ultimately our website, i.e. YouTube channel, and Shannon is the boss. And she already answered that. So I don't know why I even looked at that, folks. Sorry about that. Thank you, Shannon. All right. So what all lenders look for now. Let's see if there it goes. I want to talk to you about the hierarchy of lending. And this is just something that I've been playing with for many years. It's a concept, but it's really important that you know these things. It's the best. This is going in an order, and it's almost, if you could view it, I should have probably made this a pyramid. If I was smart, I would have done that. But the bottom line is the number one place you should go to for money, if you're in business, if you can, is a bank. And I will tell you the fact. It is because banks are more prepared. They have better, more efficient systems. They have processes that are less paperwork, and they oftentimes have rates that are better than some of the other lenders I'm going to talk about. So by all means, if you have a local bank that you work with, and you can go back to them and you know the people, and you can talk to them and say, hey, I need some money for this. And they say, yes, of course, come on in, your family will take care of you. That's where you need to go, period. The reason being is banks typically do not do startup loans. So they typically only do lending to very qualified borrowers. So if you have anything that we used to call, a skeleton in the closet or hair on the deal, you have credit issues, collateral issues, some sort of thing that makes it not the best possible loan, oftentimes banks will say, no, it's too much of a risk. We can't do it. That's against our guidelines. And believe me, there is nothing wrong with banks, and they're absolutely wonderful. There's no such thing as a bank that doesn't want to make a loan. But also keep in mind that since the economic crash of 2008, banks are highly regulated. And that really boils down to one thing. They have control over what they can do to a degree, but not everywhere. And so if a deal just does not fit their ability to make the loan, they just can't do it. So believe me, my title of this program, Where to Go When the Bank Says No, is not a slanderous remark against banks. They're awesome and they do a great job. It's just there's only so much they can do. So if you can't go to a bank, what's your next best bet? Well, there's a thing called a Community Development Financial Institution, or CDFI. A CDFI is basically a nonprofit or non-bank lender. And these are entities that go and become certified with the U.S. Department of Treasury to become lenders and provide small business loans to folks who cannot qualify for a loan from a bank, or they're startups, or they're in underserved communities or underserved populations. The thing about CDFIs that's really important to know is that They go above and beyond to try to make the deal happen. They're very much a person-to-person lender in most cases. However, the beauty of a CDFI is that they're willing to talk to just about everybody and try to see if they can make a deal happen. But they still have to have some level of those C's to make the deal go through. Maybe they could be a little less stringent on credit or collateral, but they still have to have something. You can't go to them. It's not a free pass kind of program. But also, because community development financial institutions take more risk than a traditional lender like a bank, they're saying, well, we believe in you. You're going to do your startup janitorial business, and we think you have potential, but their interest rates are going to be higher than a bank. And there's a number of reasons for that. The primary reason, first and foremost, is that they're taking on much more risk. They're doing startups, they're doing loans with some issues that may, cause future problems, but they're willing to try to work it through. The other side of it is most CDFIs have to borrow the money that they lend out. Many of them do, and they borrow them oftentimes from banks, but they have to pay interest and pay that back. So guess what? They have to take whatever their interest rate and add enough spread to that, we call it in the game, but more interest points, so that if they make a loan, they're making enough money to keep their staff to help you, but also pay that interest on that and then the note on that borrowed money. So they're fantastic. I worked one for 20 years almost, and I think they're one of the best things out there. The beauty in our service area, and my apologies for those of you who are outside of the service area, but here in the Fresno, Madera, Tulare, Kings area, back in the Stone Age, we had one CDFI, and I worked for it. And we were the only game in town. Did a great job, but we were the only game in town. And sometimes competition is a good thing. We now have 6 CDFIs that serve the area. We've got basically 4 that are local and 2 that are regional and come in and have staff who work here locally. So the good news is, anybody on this workshop who attends this workshop, we're going to send a copy of a CDFI list to you as part of the follow-up to this. So again, we have local CDFIs, and we have some very good ones here in town. The top 2 or 3 that I would work for is, and I'll just get that pulled up in a minute during the Q&A. The other thing that you need to think about, CDFIs are great, and if it works, do it. But sometimes in your communities, there are local or regional lending sources that are kind of sprouting up for various reasons. Sometimes, like here in the city of Fresno, we have an economic development and then some stimulus money funded City of Fresno grant, our loan program. In the city of Porterville, they have a loan to grant program for folks who keep people and retain them as employees for a period of time. You get a loan and then it turns into a grant if you keep your people long enough in the city of Porterville. The city of Tulare has a revolving loan fund, it's called. It means they loan the money out, and whoever pays them back, they loan them money out again. There are funds called CDBGs, Community Development Block Grant Funding, that goes either to economic development or to housing. If it's economic development, oftentimes a municipality who gets that, whether it's a county or a city, will use those funds to start a revolving loan fund or a small business loan fund. And those are amazing deals, but they're a little time consuming, but worth every bit of your time. There's a CDBG loan fund, for example, in Madera County that provides loans to businesses in Madera County who want to expand, and it's based on being in Madera County and creating or retaining jobs. Very important. And based on that, it's a very low interest rate, but it's a time-consuming, slower process. So depending on your need, if you don't have a long-term need and you're located in an area, ask your local cities, counties. I'll talk about some of the people you could talk to. Ask them, are there any local loan funds out there? Look under the rocks. Again, if you're in our service area here in Fresno, Madera, Tulare, Kings, we know them all. We work with them all. We work with everything local, regional, and even out of the area to see if we can find good deals for our borrowers. So work with your local SBDCs and so forth. And I'll talk about that in a minute. For those of you who are not familiar with it, crowdfunding or crowdsourcing, depending on which definition you want to see. But crowdfunding is literally where you post your project online and you ask for money, and you hopefully get people to invest in your business. And depending on the structure of it all, you pay them back. The two most popular ones, and there's others out there, and that's another workshop altogether, but the two that are most popular are Kiva, and we do have one here in the Fresno area. It's operated by the Fresno Metro Black Chamber. What Kiva is a really unique platform. I used to manage one of these, and I really like the program a lot. It's basically for up to $15,000, you post your project or your need on the Kiva website, and investors all over the country look at this and they say, oh, okay, in $25 increments, I'll invest. And with all crowdfunding programs, you get a window of time, and you have to raise the money you want to raise within that window of time. If you don't get it. If you do, you get it and you pay it back. So for example, when I was doing a Kiva program, and it was a smaller amount, I had a client who grew artichokes, various varieties. I didn't know there was like 200 varieties of artichokes. Okay, that's really cool. And she needed a greenhouse that cost $5,000. So she posted it, and she had 60 days to raise $5,000. She did such a good job. She posted a great thing. She got people excited. If people sent her an email, she sent one back. And basically she got her $5,000 in about 2.5 weeks. Now, the way Kiva works is it's a 0% interest loan, and you start paying it back once you get the loan. So 0% interest back then on $5,000 was $250 a month. Pretty good deal. Again, I believe they still offer 0% interest, but up to 15,000. So $750 is the math. It's the highest you pay every month on your loan fees for that. Now, other programs like Kickstarter, GoFundMe, and all these different things that are out there are good, but they also have an equity component, which means you have to turn around and usually offer something to your investors. So for example, I invested in a local brewery recently, and because I did that and they made their goal and they got their money, I am getting swag. I'm getting a mug and a t-shirt and all these things for being an investor. And ultimately, there's a chance for me to get paid back on this down the road. But you got to be careful when you're doing something like Kickstarter or GoFundMe, especially because if there's a repayment clause or there's an equity or a prize clause. I did another one a couple of years ago for a local city here in the Central Valley that just wanted to raise money for the city, and they created their own salsa, and it was the city's name and the salsa. And you gave them $100 and you got a little case of salsa. Well, if you didn't get your case of salsa, they would be in default, and the whole program would get voided out, and you'd have to just pay it back. So make sure that if you go into any of these crowdfunding type platforms, that you think it through and you can do what you say you're going to do, because if you don't, it will basically default the whole program, and you'll have to pay back every investor that you got. So a little bit of risk there, but it is something you can consider. It's a much more bigger subject matter. So, again, if you have questions, always talk to local folks like your SCORE counselors and SBDC counselors who can really help you out with that. This one, well, I used to say something much worse than this, but online lenders, do your homework. Please do not, if I had a nickel for every time I worked with a client who, they heard a commercial and it just sounded too good to be true. And how many of you out there have heard the expression, if it's too good to be true, it is too good to be true. There are a lot of online lenders still out there who do things where they charge different structures and rates, whether they're daily or they charge interest per day and it accumulates. There's a lot of different structures out there. Just if you're not sure, don't sign on anything till you check with somebody else. I had a client about 6 months ago come to me who was in a very solid contract with an online lender, And after we did the math, they are paying on average about 400% interest. You just don't want to get into that. Now, to the defense of some of the good players out there, there are some online lenders who especially came out during the pandemic and did a really good job of helping people. They're starting to come around, and there's some good reputable online lenders out there. But again, check the references, do your homework. If you're not sure, talk to other people about it. Online lenders I used to say, no, don't do it, no matter what. I think we're seeing an evolution here where online lending might be a way for you to go, but you've got to be very, very careful about compounded daily interest. Oh, we'll only take 20% of your daily profits. That could turn into some massive payments. So just be very careful about that. Again, this is not something we used to really encourage, but there are some cards out there, credit cards, that have really good terms and rates. If you got really good credit, you're probably going to qualify for a bank loan or a good CDFI loan. But if you have somebody, a credit card company, that says you have 0% interest for a year and you feel like you really can accomplish what you want to accomplish and pay that off in a year, and you have that kind of strength and diligence, it's not a bad option. It's just unfortunate. I don't see very many people who have that capacity, and then they end up saying, ooh, now I've got 28% interest I got to deal with. So be very cautious and compare the rates and terms and make sure there's no penalties with anything. And finally, and sometimes my favorite, sometimes may not, there are the 3 F's of lending that you can go to when all else fails. And for those of you in the audience who've ever talked to me before, you know this, but if you do not know, the 3 F's of lending are family, friends, and fools, where you can go to family members and say, if you believed in me ever in your lifetime, please help me do this kind of work. Let me get this done and give me some money. Friends, associates, help me get this done. Or who do you know who can help me get this done? And then finally, fools, people who believe you and just say, I'll just invest. But I will tell you, it sounds kind of silly, and it's not meant to be that way. I have one very strong memory of a deal I worked on where, because of the way this company's business had a house on the land and all these different things, it was really hard to pledge their property. It was zoned in a very odd way. And they wanted to sell everything and keep the house. But it was just a mess. They could not get a loan to do some construction for some new warehousing they needed. Well, the owner's father said, I'll help you, but I don't feel very comfortable about this. Well, we sat down together, as an SBDC client and counselor, and I was their counselor at the time, and we drew up a promissory note. And we basically said, okay, this says you're going to pay these wonderful people, your parents, back within a period of time at this much interest rate. Every month you make a payment. And it was much more money than they'd ever earn in a savings account. And it documented everything, and they paid it off as agreed. And now they went from, this was many years ago, they went from 3 employees, they're at 65 employees, and they bought a whole new facility with 5 buildings. So they're doing quite well. So sometimes those 3 F's are a great starting point for moving forward if you don't have any other choices. And here's what you really need to do. The worst thing you could do is try to go at this alone. I will tell you, there was a time in my life where I was not a lender, and that was a big black box. And how does that work? I don't understand that. So it's okay to not know how lending works. It's not okay not to ask for help. So it's very important that, again, I'm going to always push our organization because I think we do a really good job, but any small business development center throughout the country can help you wade through your options. You may say, hey, I talked to these people, and here's all what they said. What do you think I should do? Well, after looking at it, here are your options, and you make the choice, and we can help you, focus in on that. Or you may not know of a program that was out there that might apply to you. We get weird programs here sometimes that just, pop up out of nowhere, where it's, oh, here's a one-time only program. We got to spend some money in Fresno County, and it's going to be a very low interest rate. We'll spread the word. We have a partner agency, SCORE. I don't know how many of you know about SCORE. You should all know about SCORE and SBDCs, but SCORE used to be known as a Service Corps of Retired Executives, and I think they just go by SCORE now. They're the share of small business development. But SCORE is a great group, and that's volunteers who can sit down with you, and everything like us is no charge. But feel free to talk to a local SCORE counselor or SCORE rep. And then the U.S. Small Business Administration, of all the government agencies, and I'm not saying this because they fund us, I just use it a lot. Go to their website. It is an absolutely phenomenal website. It has more information and training and details and information and examples of things than you could ever imagine for small businesses. And you oftentimes can get your questions answered there. But you also have, anywhere you are, you have local chambers of commerce, you have economic development corporations, and even city and county economic development staff. Feel free to reach out to them. Oftentimes they'll refer you back to folks like us, but if they can help you or tell you about maybe a program they have, a financing program with the city or county or the chamber, great, they can help you out that way. But the most important thing to do is to ask them and reach out for help. You're not in this alone. And I will tell you, the old rule of thumb happens. Who becomes an expert at lending? Somebody who's gotten more than one loan. And so you got to go through the process, learn as you go, get the guidance you need, and know that you have all the options we mentioned earlier. You've got these different kind of options. And again, ask around, see what you can do to find that out. So with that, I want to open this up for any questions. Shannon, do we have any questions in the Q&A?
Not yet.
Okay, well then it's obviously we've answered everything you need to know. And what we will do is, for anybody who has registered for this, I will send you a list of our local CDFIs here in the 4-county area who are serving our area. And then if you're not sure and you're outside of our area, feel free to send us an email to go through at the bottom of the screen here, the vcsbdc@cloviscollege.edu, and say, hey, can you help me find the SBDC near me? And we'll be happy to send you a link. So with that, I'll wait a moment and see if we have any questions. I see we have something in the chat. Okay, thank you, Scott. We will be sending that out hopefully very soon. And again, this is what we hope to be a good start webinar, and it got you thinking about what you may need to do. Please feel free to reach out and we will get somebody to sit down with you one-on-one and help you through the process. So unless there are any other questions, we're going to go ahead and end the workshop now, and then say thank you all for attending, and we hope you have a wonderful day, and we wish you nothing but business success. But we have one more in the chat. Oh, thank you, Rachel. Again, wonderful crowd. You're not tough on me at all. So again, please save your questions, get them to us at some point. We'll help you out. So with that, Shannon, if you can close the workshop, we will get this done.